You know that feeling, right? Just drowning in this constant stream of global news. Feels like a fire hose sometimes, and you're trying to catch a drop. Well, today we're going to do more than that. We're doing a deep dive. We want to really get under the surface of these escalating tensions in the Middle East, specifically between Iran and Israel, and crucially, what that means for the wider world and maybe for your investments.
Exactly. And what's important here, I think, is we're not just repeating headlines. Our mission really is to pull out the most vital bits of insight from all sorts of places. We're looking at financial analysis, sure, but also geopolitical intelligence. We want to help you understand the why behind it all and how these things ripple outwards. We'll look at, the immediate market jitters, Iran's strategic thinking, and then the bigger picture stuff like oil and gold.
Okay, so let's start with that market reaction. Big geopolitical events,
Yeah.
wars, attacks, even major elections. They always inject uncertainty, don't they? And uncertainty, well, that usually means market volatility.
Oh, absolutely.
We saw it immediately with this surprise attack by Israel on Iran just this week, published June 13th. Right away, the big stock indexes dipped in early trading, and oil prices, they jumped. Predictable, maybe.
Yeah, that's the classic initial response, almost like a reflex, isn't it? A sharp drop. Investors are reacting to fear, trying to figure out what this means for the economy down the line. It's that flight to safety you always hear about.
But here's where it gets, well, really interesting when you look back. That initial panic, often it's just that. Initial history actually suggests the long-term hit to markets from these kinds of events is often, well, surprisingly limited.
Really is striking.
Other things like, company profits, interest rates, they tend to be the bigger drivers over time.
You're absolutely right. If you step back and look at the S&P 500 data after major shocks over the last century or so, a pattern emerges. Take Pearl Harbor, 1941, a huge shock. The market dropped, 3.8% initially? But it recovered fully within 307 days, even though the total drawdown got close to 20% eventually.
Wow, okay.
Or the JFK assassination in '63, only a 2.8% dip, recovered in one day.
One day.
And even September 11th, 2001, terrible event. Markets fell 4.9% at first, but they found the bottom in just 11 days and were fully recovered in 31 days.
That's faster than people might remember.
It is, and more recently, the Russia-Ukraine war, the Israel-Hamas war last year, similar story. Initial drops, yes, but relatively quick recoveries. It's actually pretty rare for markets to close entirely because of this stuff. Happened during World War I for months back in 1914, and then for 3 days after 9/11. But that's about it.
Okay, so that's the market context. Let's pivot a bit. Let's talk about Iran itself. Our sources are describing their response to this offensive as constrained, reactive. Now, Iran has significant military power, right? So why the restraint? What's going on there?
Well, it seems Iran's actions are being shaped pretty heavily by a growing sense of vulnerability. And critically, a need to avoid getting the U.S. directly involved militarily. They've had operational losses. Damaged infrastructure, some underground missile bases, apparently inoperable. So the thinking is they're holding back partly out of necessity, not just as a strategic choice.
So it's not just careful planning, it's also practical limits.
Seems that way. Between June 13th and 16th, reports say they launched 11 waves of retaliation, over 370 ballistic missiles, more than 100 drones. Big numbers. But analysts describe these strikes as phased, limited, and tactically constrained. Very deliberate pacing.
Controlled escalation.
Exactly. We did see some new tech appear, like these jet-powered Shahed 107 drones, and some pretty heavy 1.5-ton warheads used on Tel Aviv recently. So they can still hit hard, but they seem to be measuring it out carefully. And it's also telling, I think, that they pointedly avoided hitting U.S. assets in the region directly, though they have let allies, like the Houthis, conduct some joint operations against Israeli targets.
Okay, so it's this delicate dance, trying to deter without provoking an all-out response, which brings up their underlying military thinking, right, their doctrine. What drives those choices? Has it always been this way?
Right. Well, Iran has the biggest missile arsenal in the Middle East.
Yeah.
That's kind of their thing. It was really cemented back in May 2014 by the Supreme Leader. He apparently called limiting missile development stupid and idiotic, said mass production was the main duty.
Strong words.
Very. And this focus, it comes from what analysts call path dependency. Think of it like a riverbed. Once it's carved, it's really hard to change the river's course. For Iran's specific historical moments carved this path towards missiles. The revolution itself, purged the Western-trained officers. There were coup plots. Then the brutal Iran-Iraq war. Iraq had better missiles, so Iran had to get SCDs from places like Libya and Syria. And they started building their own missile industry by '85. Then China helped in the early 90s.
So event after event pushed them down this specific path.
Precisely. And this doctrine, well, Iran sees it as defensive and deterrent. But it creates a dilemma now. Missiles are great for retaliation, yes, but they're less effective against newer threats, like sectarian terrorism. Those groups aren't really deterred by missiles in the same way a state might be, so that historical path makes them maybe less flexible today.
Interesting. And what about the nuclear question, especially after these reported U.S. bombings on their nuclear sites? Our sources mention this idea of nuclear ambiguity as a kind of legal shield. What's that about?
Yeah, that's a really crucial part of their strategy right now. Despite the U.S. hitting key sites Natanz, Isfahan, Fordo on June 22nd, Iran has not pulled out of the Nuclear Non-Proliferation Treaty, the NPT, and they haven't kicked out the IAEA inspectors, the UN's nuclear watchdog.
So they're keeping that international framework in place.
Exactly. It gives them a legal and diplomatic standing. It makes it harder for Israel and its allies to claim Iran has crossed the line into actually weaponizing its program without, clear proof. And it helps them avoid triggering a massive preemptive strike before they have either a fully working weapon or a truly credible deterrent. It's a clever, if risky, game.
Walking a very fine line, it sounds like. Strength, but avoiding total war. But what's the impact inside Iran on the people? Are these strikes creating pressure that might, change their government's calculations?
Well, the human cost is significant. Reports mentioned over 220 Iranian civilians killed in Israeli strikes. Hospitals damaged. Farabi Hospital in Kermanshah was mentioned. Power grids disrupted in Tehran. Even the state media broadcaster, IRI headquarters, took damage. And yes, Iranian analysts do see this as a deliberate attempt to create public pressure on the regime.
But is it working? Are we seeing signs of that pressure leading to change?
Not in the way you might expect, based on current sources. There hasn't been mass unrest, no major political rupture reported. Instead, sources describe this feeling of ambient dread, just this pervasive anxiety. The government's narrative, meanwhile, is all about sovereignty, resilience. They're keeping things like metro shelters open, ministries running, even while under attack, projecting stability.
So immense pressure, real human cost, but not yet a breaking point internally, it seems, which leads us back outwards. If Iran feels constrained, both militarily and maybe internally, what does that mean for the global economy? Let's talk oil and gold again.
Okay, yeah, stepping back to the wider ripples. Oil first. The Strait of Hormuz. Hugely important. It's only about 34 miles wide at its narrowest, and nearly 20%, one-fifth of the entire world's oil supply flows through it.
20%! That's massive leverage.
It is. Goldman Sachs did an analysis back in April, laying out scenarios for Brent crude. They saw, like, a 60% chance of no major disruption. That would put oil around $60 a barrel by the end of 2025. Then a 30% chance of moderate disruption, say a 10% cut in flow, pushing prices to maybe $85, $90. And then the extreme scenario, only a 10% chance, a 50% cut for a month. That could mean $110 oil. Barclays even warned it could go over $130 if Hormuz was fully blocked.
But you mentioned Iran might be hesitant to actually do that, to fully weaponize the strait?
Exactly. It's kind of a nuclear option for them, economically. Closing Hormuz would cripple their own oil revenues just as much as anyone else's, and would almost certainly trigger a massive U.S. military response. So a full closure, it's seen as a low probability, very high impact event, a black swan, basically.
Right.
Which leads to this weird geopolitical paradox. The short-term risk spikes prices, like we saw, but the longer-term outlook for, say, 2026, it's actually kind of bearish for oil. Maybe around $56 a barrel. Why? Because there's a structural oversupply. Lots of new oil coming online from non-OPEC countries, places like Brazil, Canada, Guyana. They're adding something like 1.2 million barrels a day by 2026, more than demand growth. Plus, you always have the possibility of OPEC plus changing course, maybe even another price war.
Fascinating. Short-term fear versus long-term supply realities. Okay, what about gold? The classic safe haven. How's it been doing?
Gold has definitely been acting like a safe haven. XAUSD, the spot price. It surged past $3,400 an ounce, hit $3,443.55 on June 16th. That's really close to its all-time record high, around $3,500.
What's driving that surge? It's the Iran-Israel tension.
That's a big part of it, yes. Investors rushing to safety. But there's another key driver. Softer U.S. inflation data. We saw weaker numbers from the Consumer Price Index, the CPI, and the Producer Price Index, PPI. And that has boosted hopes or expectations that the Federal Reserve might start cutting interest rates sooner rather than later.
Ah, and lower rates make gold more attractive.
Exactly, because gold doesn't pay any interest, right? It doesn't yield anything. So when interest rates are high, The opportunity cost of holding gold instead of, say, bonds is also high. But when rates look like they might fall, that opportunity cost drops, makes gold relatively more appealing. Now, technically speaking, analysts are watching resistance levels around $3,450 to $3,500. Could see a bit of a pullback if people start taking profits. What happens next with gold really depends on, well, the Fed meeting, any new geopolitical bombshells, and more U.S. economic data.
Okay, so beyond oil and gold, what about the wider diplomatic fallout, especially after the U.S. got directly involved with those bombings on June 22nd? How are other countries reacting?
Right, that U.S. direct involvement was a major escalation. Bombing Natanz, Isfahan, Fordo, the former U.S. president called the massive precision strikes a spectacular military success. He even threatened more if peace isn't reached quickly. Iran's reaction, furious condemnation. Their foreign ministry called it a gross and unprecedented violation of international law, accused the U.S. of blowing up diplomacy, said they reserve all options to defend themselves, and their IRGC, the Revolutionary Guard Corps, basically said U.S. bases in the region are now fair game, promising regrettable responses. Iran's foreign minister was also reported to be heading to Moscow for serious consultations with Putin.
A lot of heated rhetoric. And the rest of the world?
Pretty divided, as you'd probably expect. Israel's leaders, Netanyahu and Herzog, obviously praised the U.S. strikes. Russian state media condemned them, called them irresponsible, a violation of law. The UN Secretary General expressed grave alarm, warned things could spiral out of control, urged de-escalation, saying there's no military solution.
Any other key players?
Well, Iran's allies, like Hamas and the Houthis, condemned the U.S. and vowed retaliation. Though reports suggest groups like Hamas and Hezbollah have had their fighting capacity degraded by recent Israeli actions. China's state media raised questions, asking if the U.S. was making another Iraq mistake. France, interestingly, wasn't involved in the strikes. They reiterated they don't want Iran getting nuclear weapons, but called for talks within the NPT framework. You also saw splits elsewhere. Left-wing governments in Latin America condemned the attacks, but Argentina's libertarian president praised them. Oh, and air travel is still heavily impacted. Ben Gurion Airport in Israel reopened temporarily for repatriation flights, but most airlines are giving large parts of the Middle East a wide berth.
Okay, so it's a complex, volatile picture globally. Bringing it back home then, for someone listening to this, trying to manage their own financial situation, what can you actually do to navigate these kinds of turbulent times?
That's the key question, isn't it? How do you protect your portfolio? There are really three core strategies for managing geopolitical risk in your investment. First, fight that urge to panic sell. Seriously. History, as we've discussed, strongly suggests these market impacts are often short-lived. Markets tend to recover, usually within months. Selling in a panic just locks in those temporary losses.
Easier said than done sometimes, but okay. Don't panic. What else?
Second, diversify. Spread your investments out, different asset classes, stocks, bonds, maybe some commodities, different sectors, different parts of the world. Diversification is your best buffer against downturns hitting one specific area too hard. And third, maintain a long-term focus. Think in years, not days or weeks. Having that long-term perspective helps you ride out the uncertainty without making rash decisions.
Solid advice. Any more specific strategies analysts are looking at?
Yeah, for those comfortable with more complex tools. In the oil market, some analysts suggest using things like call options on Brent futures to bet on prices rising, but maybe buying put options too, as protection if prices fall instead. Hedging your bets, basically. Others suggest investing in big integrated energy companies or midstream assets pipelines, storage which might offer more stability than pure exploration companies. Or if you think oil prices might actually collapse long-term due to that oversupply, maybe rotating into renewable energy stocks. And there's even a policy angle related to what we discussed earlier, this idea of using cost-imposing strategies against Iran.
Cost-imposing strategies. Explain that a bit.
Sure. It's about making an adversary's preferred strategy, in Iran's case, their heavy reliance on missiles, due to that path dependency, more expensive or less effective.
Yeah.
So if you can develop defenses or counters that make their missiles less useful against modern threats, you raise the cost for them to keep investing so heavily in that one area.
Right.
The idea is to try and nudge them, exploit that path dependency, to shift their resources elsewhere, maybe making their overall military posture less efficient over time. It's a strategic countermove.
Right. Fascinating. Okay, so pulling all these different threads together, we've gone from the immediate market shocks through the history of how markets bounce back. We've looked inside Iran's strategic thinking, that path dependency, the nuclear ambiguity, and then explored the ripples hitting oil, gold, and global politics.
We have. And I think this deep dive really highlights something important. In a world where these big geopolitical events can feel, frankly, overwhelming, understanding the underlying drivers, the history, the strategic calculations, it empowers you. It helps you see beyond just the scary headlines. And it raises maybe a final question for you to think about. If even powerful nations, like Iran, can be sort of trapped or constrained by their own history, their own institutional inertia when it comes to adapting, what does that teach us about our own agility? Not just in how we invest our money during a crisis, but in how flexible we are in adapting to new information and navigating this incredibly complex and fast-changing world. Something to consider.